I want to turn over Matt Kramer. Matt Kramer is a partner at Weinberg Wheeler, and he's going to be leading the session that's coming up now. Matt, are you on the line with us?
I am, Mike. Thank you.
Thank you, Matt.
So, Mike, thanks for putting this together today and tomorrow, and for the prior events, and to your group. We've got a fantastic panel discussion right now on structuring trends, creating a win-win for general partners and investors. We'll briefly give backgrounds of each of the panelists and the like, and then we'll dive into the substance. Briefly, I'm a corporate transactional partner with the law firm of Weinberg Wheeler in Miami. I represent owners, developers, buyers, and distressed investors in a wide array of real estate transactions, including experience structuring mezz, private equity, and EB5 transactions. I represent landlords and tenants on lease transactions. I have experience in construction financing, code compliance, and title issues. I also handle litigation matters, including commercial foreclosures on behalf of servicers and lenders. I will now, we can go to just identifying each of the panelists and their background. Lane, could you give a description of your background, please?
Sure, thanks, Matt. My name is Lowry. I'm with QOZ Portland. We have a fund in Portland, which is rated the #1 opportunity zone out of the 8,760 opportunity zones. And my background is in all aspects of development, starting with distressed properties back in the 90s and working my way up through all the different food groups, so to speak, and have decided to focus on multifamily. We have become experts, if you will, in structuring transactions in opportunity zones, focused on the tax benefits that are available for the sponsors and for the investors. And we're going to dive into that deeply today. Back to you, Matt.
Thank you, Lane. Bruno?
Good morning to all. Thank you very much, Matt. I'm partner at PP Tax. We are a consultancy firm that essentially provide tax services for asset managers, financial institutions, and both individuals that want to invest either in the financial or real estate market here in the US, mostly foreigners. And during this panel, our goal here is to evaluate eventually structures that have been used in order to defer or to avoid taxation here in the US for foreign investors in real estate projects.
Thank you, Bruno. Mike?
Mike Mangione, we cannot hear you. Perhaps you're muted.
Can you guys hear me?
Now we can, yes.
Yes.
Okay, apologies for that. Yeah, no, the problem was on my side. The connection is good. Thanks a lot, everyone, for being here, and thank you, Flya, for setting this up. Essentially, I represent Group RMC and the director there. What we do is essentially we're a co-investment group of family offices, high net worth individuals, and institutions that get together and buy very large office properties and portfolios from end-of-life funds. Typically end-of-life funds from big institutions like Blackstone and Honeywell Pension Plan and Northwestern Mutual, and very reputable institutions who oftentimes need a liquidity provider in markets that have a tendency to have less liquidity, like in non-gateway markets such as Kansas City, Indianapolis, Illinois, Memphis, Columbus, Ohio, and whatnot, which we call today, and I'm seeing it as a theme, called non-gateway markets. So we're the largest landlords in a handful of these cities. We have about 18 million square feet, $2 billion in assets, and it's just really, deal by deal or open-ended structure, which we can talk about later.
Thank you, Mike. Demian?
Hi, can you hear me? Just testing before
Yes.
I start. Great. So thank you, Matt. Thank you, everyone. We are essentially in origin a multifamily office, very classical, working with foreign investors, mainly from Latin America and Europe, established in 1996 in New York. But early on, we had received demand for our investors for direct co-investment opportunities, alternatives, liquid investment opportunities. So we established in 2004 a alternatives platform, which is Confidas Capital. And during this period, we have helped our foreign investors, both clients of Confidas Group, but also relationships that we've had both in Europe and Latin America to invest in the US. Most of what we've done, we did some private equity, some venture capital, most of it has been real estate. And for the last 5 years, we specialized ourselves in investing in real estate debt in the US. So we've partnered with a group of lenders across the country and different asset types and geographies and loan types. And we've been very actively co-investing in real estate debt in the US for foreign investors, also from the regions, Europe and Latin America.
Thank you, Demian. Lane, if I could start with you, how does your opportunity zone investment structure benefit investors?
That's a great question. The investment in an opportunity zone fund has a lot of different tax benefits as well as the income that it provides. Our fund has an original use asset. This means that the completed property receives all the benefit of an opportunity zone fund, which, as many know, is an opportunity zone fund is designed to spur development. Often that takes several years to occur. Because the asset is completed, we are able to pass through very large non-cash losses in the form of depreciation and the operating expenses for getting the building leased up. This can result in tax savings that exceed the invested dollar in the very first year. It's absolutely amazing. So what we've done is we've structured our fund to deliver the tax benefit of depreciation to each investor in the first year of investment. Then over the life of the fund, we continue to invest in properties to deliver more depreciation. And then at the end of a 10-year hold, the assets are marked up to fair market value. When this occurs, the capital gains tax is forgiven. But what isn't so well known is that marking up to fair market value also relieves the investor of depreciation recapture. We have done an analysis to show that the benefit for an original use asset with like a 3% growth rate, the depreciation forgiveness exceeds the capital gain forgiveness. And this is a benefit that a lot of people are not focused on. So that is the main area of benefit, is the tax benefit. And I'm looking forward to telling you more about it.
And Lane, who is your ideal investor for your funds?
Well, the investor would come with a capital gain, either from sale of stock, it could be a short or a long-term gain, or a 1231 property gain investor. This is a unique situation where a person with 1231 property gains, they've sold a piece of property, they can invest the gains from that sale, and then if they have any offsetting losses, now most people are looking for ways to offset their income. So if they have 1231 property losses, those losses can then be used against ordinary income. So instead of using those losses to shelter a capital gain, it could be used to shelter an ordinary income tax liability. This is where the returns can really grow. And some people are actually focused on how to generate losses this year, because the CARES Act has allowed investors to carry back net operating losses for 5 years. So 1231 gain investing to get rid of those gains is a very important part of that strategy for some investors. And then of course, 1031 exchange investors are increasingly dropping out of 1031 exchanges and investing in opportunity zone funds, because they only have to invest the gains and they can put the basis, any other cash, and relieve themselves of any other debt when they make that transaction. So those are the ideal investors for us.
Thank you, Lane. Bruno, I know your focus is with foreign nationals and the like. From a taxation standpoint, what's better for a foreign national, to invest in direct lending to real estate in the U.S., or to just simply invest and purchase real estate?
Perfect, but thank you for your question. It's quite appropriate. Essentially, the foreign investor has an explicit tax treatment here in the U.S., and most countries in Latin America, for instance, we don't have a tax treaty with the U.S. If we do the direct investment here, we'll probably have the 30% withholding tax for non-resident aliens, as crypto legislation establishes. Therefore, asset managers, they normally set up a offshore entity to be able, so they will be able to invest throughout the portfolio interest exemption here in the US, where you don't have the withholding tax paying back the interest of that loan that you give. Therefore, your investor will be able to have a better result. The other thing that's important is taxation of succession, because here in the US, the non-resident has a threshold, a limit threshold of $60,000 of exemption on state tax. So if you invest direct throughout the US entity or US investment vehicle, you will have that issue to face in the upcoming future. That's why eventually structuring your investment, either is a co-investment or a direct investment throughout an offshore entity, it's better suited for a foreign investor. But the co-investment will have much more a better tax result in that perspective.
And when you speak of co-investment, can you generally describe the main types of co-investments in real estate and their taxation on distributions?
Definitely. Normally, when you do a project aiming a foreign investor or a pool of foreign investors to participate in, you create an offshore fund, and that fund will be the entity that will receive all the assets, all the investors, and that fund will then have a hybrid participation in the U.S. vehicle. It will participate in the blocker, which is normally a U.S. corporation that will be the holding that will invest in the real estate, commercial real estate projects that I have, and it will also have the lending to that vehicle. That loan that the offshore entity provides, when it's returns, when it's paid back, when it returns, it's exempt of given all the requirements, the IRS requirements are fulfilled. It's tax exempt. It doesn't have the 30% withholding tax. And normally the fund that receives all the investments, it's located on a tax-free jurisdiction. Therefore, you can provide a better return to the investors, and they also don't have succession implications here in the US.
Thank you, Bruno. Mike, if I can turn to you, how can a fee structure create alignment with co-investors?
Right. And before I get into that, I just want to say what Bruno said was extremely important for offshore investors. When you have Cayman structures and U.S. blockers, that portfolio debt exemption is really important to bypass withholding taxes that you have in the U.S. and estate taxes. So I'm happy to hear that. That's good information. Fee structures is an interesting one because I'm sure a lot of people on this panel and in attendance have that kind of fee fatigue. You know, you have a lot of layers of fees. You know, you have the asset management fees, the performance fees, the carry fees. Sometimes you have the high water mark with catch up and without catch up. And frankly, a lot of them offer some good alignment, and others maybe are a little bit too severe. So it's good to navigate your fee structure, not just on how to save from the bottom line, but what I've also noticed is that different kind of fee structures will also allow a manager to go into different markets or to go into a different mandate. Now, for example, one thing that I find interesting is we don't charge, you know, typical performance fees and asset management fees and hurdle fees and all that stuff. And then we don't have hurdles. And so we're a little bit different. We're really a co-investment group. So what we do is we charge a one-time markup up front, but we take that as limited partnership shares because we're limited partners. So if the deal does well, we do well. If the deal doesn't do well, we don't do well. And on top of that, we put in a lot of our own money in every single deal that we do. So there's a lot of alignment. But that's just the fee structure. It doesn't really end there. I think what could be interesting to share with everyone is it's precisely that allows us to invest where we're investing. So we tend to buy very high income producing assets, you know, the 8 to 10% cap rates, Class A stuff. And usually you find those metrics in less liquid, I guess less transactional markets like in the Midwest and the Southeast. Now, if we were to charge a performance fee, in order to crystallize that performance fee, we would need to sell the assets. And so we would need to be in more liquid markets. That's why you see a lot of transactions happening in the Silicon Valley in California, and the coast in Manhattan and all that stuff. You can't really be structured that way and buy things in the Midwest where, we find attractive deals. So why I find that interesting is that, we could buy a deal from Blackstone and they could have made a very good profitable exit. And, we're finding ourselves, because our structure is different, we go in with permanent capital, we can start bidding in markets where there's not that much competition. So there's no bidding wars, there's much lower pricing, much higher yields for the same kind of tenants. So I just want to highlight that, depending on the way you're structured, it could feed a mandate in such a way that you don't necessarily have to be the smartest person in the room, but the structure can allow you to buy better than most people in the room. And so that was just an example that I'd like to share for sure.
Matt Kramer, your mic is on mute.
I'm sorry, can you hear me now?
Yeah, we can hear you.
Mike, what are the various investment structure options that you either offer or that you're seeing in the market?
Okay, yeah. And, Bruno mentioned one before, and that was also interesting. So just as a background, about 40% of our co-investors and the families and the institutions that invest with us are outside of North America. Most of them are from, that 40% you find in Europe and in the Middle East. About 30% are from the US, and the other 30% is in Canada. And so the interesting thing that we have to do is come up with, structures that allows these co-investors from all over the world to invest in a tax efficient way. So Bruno mentioned the Cayman blocker or the Cayman feeder and the US blockers, which is absolutely key. Members at Fly have also, like Marcelo, have spoken to me about RAFE or Lux CCAV and regular alternative investment funds, which a lot of people have been doing with the European passport, which is a very reputable way of doing it. And then you have institutions that are often considered nonprofit organizations that go directly into a U.S. blocker. So it's a proper treatment for UBTI or unrelated business tax, which is extremely important for them too. So you can create a U.S. blocker for that. And then going a little bit further on the investment type, oftentimes co-investors or families, they want to do deal by deal. They want to pick and choose their deal and build their own portfolio. So that's interesting for many. But you have larger multifamily offices or RIAs who don't want to do or go to the investment committee for every single deal they get presented or they're interested in, which is an extremely lengthy process, creates a lot of line items in their statements. So what I've also seen and what we've developed also is in tandem are feeder funds, which are essentially open-ended limited partnerships. And what these things do is instead of having to invest in every single deal, one deal at a time, and pick and choose your deal, you just invest one time in this feeder fund. It aggregates a lot of investors to come in as one very large limited partner that invests alongside the other direct limited partners. But more importantly, it automatically participates in every single deal going forward, creating automatic diversification. So you get one line item on a statement, a quarterly NAV, quarterly distributions, and just massive diversification. So in short, you have different structures to allow different investors to come in depending on if they're institutional, nonprofit, overseas, onshore. And then you have the close-ended or deal-by-deal co-investment versus the open-ended co-investment. I'm very happy to talk about any of these structures after this call as well.
So in your experience, are the structures driven by what the investor is looking for in terms of return on investment and their appetite for risk?
Yeah, in my mind, it should the kind of going either you go open-ended or close-ended shouldn't affect your returns. I think what you nailed it when you said risk. Now it depends on your sophistication. There's a lot of sophisticated single-family offices with investment committees that like to pick and choose their deals and create their own portfolio. They might be looking for more upside, or they might be looking for more income, or they might be looking for a specific market. So the mandate is much more tailored. Where there's other groups who say, you know what, I trust the manager, I trust the mandate. I'm looking for target returns of say, 10 to 15%. With X amount of downside, on your risk-adjusted returns. So I'll invest in the mandate and just let it perform for me. So the idea is for the returns to be very similar, but you get a more tailored experience when you do deal by deal. Now it's very tough because an investor is presented both options, and I think it really comes down from personal experience. Are you a deal junkie? Like, do you really like the deal and you want to get updates from that single portfolio? Or do you just want to invest in real estate? And if you just want to invest in real estate and that's just a sleeve in your portfolio, then maybe open-ended is more for you. But if you're more of a deal junkie and you really want to get into details of a specific deal, then it sounds like the passion lies within, getting detailed information, investing in a particular deal that you crafted. So that's just kind of what I've seen in the market.
Thank you, Mike. Demian, if I could turn it to you, since Confidas only works with foreign investors, what has been those investors' level of interest in co-investing in U.S. commercial real estate debt?
Yeah, this has been a slow-moving process that I would say has started about 5 years ago. Our core investors, which are the families that work with us, they had always exposure into real estate equity, mainly New York and up to a certain extent Miami. And slowly, through the opportunities that we saw, and also this long wait for the end of the cycle, we started to notice there was interesting opportunities in real estate debt due to the shortening of the exposure to every investment, a lower leverage point, and almost similar returns. It has been a slow process. We started with one-off deals 4 years ago, and but this has been growing. This has been growing considerably. For the last years, almost everything we've done has been in debt. We went through a long process of selecting the lenders in different areas and types of assets and loans in the U.S. We rely heavily on them, on the underwriting. Naturally, we do the due diligence of the lender itself, but then it's work done in tandem to analyze each deal and to bring it to our investors. This has grown over the years. Today we have a community of families, investors that take almost everything that we present to them. And going forward, we see there will be a balance between the two. I think it's a new asset class that in a way has established itself in the foreign markets, at least the markets that we work in, mostly for the more sophisticated investors. So I think that for the future in the alternatives platform, which is the area that I run in Confidas, we will probably see a blend between both equity and debt. Equity coming back now with this new cycle that we're entering in. So I believe equity will slowly move back into our portfolio, but that will remain solid, and we foresee that it has found its space, at least in the markets we work in. It's especially on the, sorry, just to complement on this short-term transitional bridge financing space, where banks and insurance companies and the large funds, they're not that active, and it's covered by independent private lenders. Sorry, go ahead.
No, please. Thank you. You had mentioned some of the factors incentivizing your investors to transition from equity to debt deals is shortening of exposure times, lower leverage, and obtaining similar returns. Are there other factors that your investors are focusing on to put on their debt hats versus equity hats?
Yes, there's the taxation issue. I mean, if it's appropriately structured, it's a tax-free investment for foreign investors. There is the facility of the easiness of the investment. We've learned along the way how to create the appropriate structures and vehicles so that investors can come in. So in the end, it becomes it's a short-term, easy investment, in the sense that they can subscribe to a co-investment in a much easier format. Also adding to the fact that now we've done repeat business with some of the lenders that we work with, so all the paperwork has already been vetted and approved. So it becomes an easier structure for them to come in, but it doesn't substitute entirely equity at all. I mean, maybe at this point of the cycle in the last 2 years, it did up to a certain point, but I do believe that both sides will co-invest. And through the equity investment, they use pretty much the same structure that both Bruno and Mike mentioned. And through that, then there's some other structures that we put in place that help them come in. So I see that both sides of the equation will work together in the future for these foreign investors.
Yeah, and I was going to ask you as a follow-up, what are some of the specific structuring requirements that you have or that you're seeing, whether the deal is an equity-based deal or a debt-based deal?
Yeah, so for the equity-based deal, it's pretty much what Bruno and Mike covered. It's the usual structure that is used. For that, there's more nuances to it. We tend to prefer reselling debt on a secondary market operation. So obviously that requires balance sheet capacity to season the loan. But that's usually the structure we've used the most so far. And we're looking at some other alternatives as well. But this homework needs, at least for the foreign invest, needs to be done, and that's our role, to find the right lenders, and that's something we actively are always looking for lenders across the U.S. through different types of loans and asset classes. It's a huge and highly fragmented market, so we're always researching and open to discuss with other real estate lenders. And also the way we structure the deals and the loans so that these investors can come in. And then it's more of a tailor-made, depending on the size of the deal and the investors that come in. Each one has a different requirement, but we tend to give them the ready-made solution so they can subscribe in a streamlined process.
Great. Well, thank you so much. So now it's time for the crystal ball prognostication portion of the presentment, which I know you all have been dying to hear. Lane, obviously we're in this pandemic, unclear how long we're going to be in it. What are you seeing in terms of how the pandemic is impacting opportunity zone deals, and what's your prognostication going out 6 months to a year?
Well, I do see the post-COVID world very differently than we saw it before. There's certain asset classes that are going to be affected from a demand standpoint, and this is pretty obvious. And how long that takes to work through, we've heard some estimates for hospitality taking a couple, 3 years to get back to pre-COVID levels. So it's most likely that the funds that have those assets in the pipeline but have not yet started construction, that they'll push back the construction of those projects in an opportunity zone. For asset classes like industrial or multifamily, these seem to be having the best post-COVID results. And we believe that a lot of capital is going to be driven into these asset classes as it overlooks and sidesteps larger commercial deals. Now, there are some tailwinds. The tax laws have changed, and we now have some advantages for qualified improvement property for commercial projects that can now be cost segregated out of the 39-year property group for better depreciation. But in the spirit of discussing the structuring trends, many of the funds are not yet set up, or were not initially set up to pass through the depreciation. It's important that the partners look at capital accounts and make sure that the depreciation that they allocate does not take any of those accounts negative. When going into an opportunity zone fund, there is no basis in those investments. So it's not possible to pass through depreciation unless there is basis, and basis is usually accomplished with qualified non-recourse financing. So in the case of the Portland Opportunity Zone Fund, we have qualified opportunity zone assets with qualified non-recourse financing to give basis to take the depreciation. Then we invest alongside as a limited partner with the rest of the investors to maintain adequate capital accounts with this basis being used to pass through depreciation. So the 5 and 15-year property can be cost segregated and passed through with special allocation. It can be divided up amongst the partners in the method that's defined by the manager. And we can use bonus depreciation. Up to 100% of the 5 and 15-year property can be passed through to the investors when the property is placed in service. So an original use asset is going to be the most advantageous. And what we see happening as far as structuring trends go is more and more funds will be focusing on acquiring an original use asset and then adjusting their fund structure so that they can pass it through to investors. Now, a REIT, for example, does not have the ability to pass through these depreciation benefits. So some of the REITs are talking about restructuring into partnerships. Now, some of the REITs do have the benefit of 199A reduction in the income, it's a 20% reduction, but that phases out with certain income levels. So I did cover a lot about structuring there and certain food groups. Overall, post-COVID is going to change certain cities more than others. There'll be a migration of people from certain cities. We've already seen it from the inner core, the core of the city, to the suburban environment. And some cities are less dense and they have a better feel. People feel more comfortable being in those environments. They're a little bit more spread out. Portland is one such market. And we've seen currently, most recently I saw rental rates for Class A apartments in New York, for example, were down 8%, while the outlying suburbs were up 3%. This is just happening in a few months. So we'll see the same thing going on with the returns from certain asset classes. They're going to go down, others are going to go up. Those are the main trends that we're seeing. There's one more very important debt-related trend. We see the markets changing as far as availability of capital. One of the sources that we're using is HUD financing. HUD financing was recently quoted at 2.6%, including the mortgage insurance premium. Now that's 160 basis points lower than where we were in a pre-COVID environment. This is going to drive cap rates down. So the favored food group, if you will, the favored asset classes will most likely see much more appreciation or value growth because of cap rate compression, simply because they have better access to capital. Now, this HUD financing is not available in very high priced markets. So finding something like, for example, in the Midwest or something in the Portland market, where we're the lowest priced market in the West Coast and the one poised the most for growth in asset value due to cap rate compression. These are things, trends that we need to watch for, and the ability to pass through the most tax benefits, which we see in opportunity zone funds. Back to you.
Great. Well, thank you, Lane. I very much appreciate those thoughts. Bruno, Demian, you both are focused on foreign nationals investing in U.S. commercial real estate. How do both of you see the pandemic impacting foreign investment over the next several months? Bruno, would you like to take that question first?
Definitely. Thank you, Matt. Essentially, as first Mike, Demian, and even Elaine correctly put it, we are seeing a change of behavior. And in that sense, you also have that on foreign nationals trying to come and place at least part of their savings in a more mature market. You're seeing that trend, and I can tell you with some confidence, because we've never been busy those months of April, May, June, where due to the crisis that led to any different kinds of situations, either in Brazil, in Chile, Colombia, Argentina, Mexico. So what we've seen is a current flow of assets coming to the U.S., either to the financial market or to invest in the real estate market, looking for a safe harbor, a safe place to put the savings of the wealthy individuals in those countries. So here in the U.S., I'd say that either throughout portfolio loans of feeders, offshore feeders investing in real estate projects here, or direct investment, we'll definitely see a spike in cases of foreign nationals, especially from countries still in development, bringing their money, their assets here to the U.S.
Thank you. Demian, do you...
Just one.
Oh, I'm sorry. Go ahead, Bruno.
It's one important thing is when you compare the tax system in Europe, OECD countries, than Latin America. In most Latin American countries, you may be able to have offshore structures that defer the payment of taxes in your home jurisdictions in even a better way than you have with local structures. So it's not even the dollar protection that those investors are seeking, but they also have a tax advantage in that point if correctly structured, if the investment is correctly structured.
Got it. Well, thank you, Bruno. Demian, do you have thoughts on how the pandemic may influence foreign investment in U.S. commercial real estate markets over the next several months?
Yeah, well, I have some thoughts, and also adding to what Bruno said. I mean, we since we deal with foreign investors in the U.S., Definitely the volatility and the uncertainty from Latin America and the low interest rates and yields in Europe have been very favorable for us. These investors, when they come to us, and when they look into debt as an option, there is a certain unsureness of whether it's a fixed income instrument or it's a real estate exposure instrument. So they juggle still to understand in what portion of the portfolio that fits in when they look into debt. This is starting to be clear for them, which also helps us a lot. They see the investment in multifamily, both on the equity and the debt side, as a safe play for them. So there's the safety is an important factor when they look, and it makes us happy to see that they approach both debt and equity as both a debt as well as a real estate play. Going forward, look, I'm sure that the other guys here in the panel can give you better prediction than we can in what is going to happen. What I can tell and add is what we have seen so far is that we talked to all the lenders that we work with. We've seen spreads and yields widening. We've seen a considerable lower leverage in the market in general, but we have not seen the distressed deals coming that for us to actually evolve on a possible investment. So I think that the market today, has a lot of dry powder to absorb all the distress that has happened and the collateral that has come out as opportunities. We think that if we are able to obtain the same rates that we had before, but a slightly lower risks or lower entry point or LTV, I think we are happy we'll be very happy and continue to analyze the deals going forward. I think there will be reshuffle in especially in hospitality and retail. It's too early for us to have an idea of how this will be. But so most of what we've done, we're looking at now, and we have closed one deal and we're looking at some others, is in the multifamily space and some industrial. We're keeping away from hospitality, from retail, of course, and also from office. I think it's very early to understand, to have a clear view of how the market will be going forward.
Great. Well, thank you. And I would add from my experience, separate and apart from the pandemic, government policy certainly plays a role in real estate investment, such as the recent Opportunity Fund legislation. I handle EB5 transactions and would note that the minimum investment has been raised from $500,000 to $900,000, and the areas that qualify to do EB5 real estate investing has narrowed significantly. So that certainly has created some headwinds regarding the ability of foreign nationals to invest in the U.S. Mike, in terms of the pandemic, do you see any structural changes with fees on deals going forward, either to further incentivize investors to undertake the risk of investing in deals during this uncertain time period?
That's a very good question. So I do think that even before the pandemic, there's been a downwards push on fees because again, like I was saying before, there's a lot of fatigue in the investment community with the layers of fees and not really knowing how much you're paying, and because it's all based on hurdles and watermarks and end of life and all this stuff, so it's very complicated. What I do think that perhaps will affect fees and the way a deal is structured is in the pandemic, I think the underwriting of a deal will have to be structured with a lot more reserves and a lot more caution than ever before. Like when you think of a lot of deals that were very aggressive on their LTVs, meaning a lot of debt versus equity, you're going razor thin on the cash reserves, they're going shorter term on their maturities, or 3 or 5 years, because the shorter your maturity, you know, the higher you hope that your IRR could be, and you collect your fees on your IRR and all that stuff. I think that's very aggressive underwriting. I think that going forward, a lot of players are going to have to be, and those who weren't already, of course, there's a lot of conservative players, but I've seen a lot of aggressive players as well. And I think the aggressive ones are going to need to tone it down, be a little bit less aggressive, be more well capitalized. You know, I know cash is a drag on your IRR, but it's extremely important when things are, you know, when things are a little bit more complicated like they are right now. I think longer term capital is going to put you in a situation where you're never a forced seller, just because you promised, you know, 3 years ago that you had to sell, which is a very easy way to raise capital, but not necessarily the most responsible way. I think longer term investors or more permanent investors will get rewarded, because you never want to be in a situation to be a forced seller. So I think more conservative underwriting and the way people structure their loans, they structure their equity, is very important. On the structure side as well, you know, I think that it's also going to open up a couple of opportunities. We're looking all the time for opportunities and for post-virus deals. And a little bit like what Demian was saying, we haven't seen that many deals, or the blood hasn't really hit the streets that much in the assets that we're looking for. But what we've seen is a lot of single tenant buildings, for example, have started hitting the streets already, and are hitting the market, in a sense that, you know, when you have a single tenant building, you either collect 100% of your rent or zero. You know, so obviously those who had low cash reserves and they didn't collect their rent, they're going to have a very hard time. And those we're seeing marketed right now. We're not interested in those because of the inherent risk involved in that. We like to have diversification in our tenancy. It's very, very important, just like anyone should have diversification in their investments. But I think that in other instances, structures like REITs, I know Lane mentioned REITs before, which is interesting too. REITs have, you know, to be considered a REIT, you need to distribute 90% of their net income. And if you're going to be doing that, it's very hard to maintain solid cash reserves. And in good times, it's no problem, but in bad times, you need those reserves. So I think that maybe some REITs, not all REITs, some REITs who already have payout ratios that are well above 100%, meaning they're distributing more than more income than they're actually generating. You know, tying in with what Demian was saying, you know, when you look at a capital structure, if, you know, you have low cash reserves, you can't really raise more equity because your share price right now is low because of the pandemic. It'd be dilutive shareholders. It's hard to raise more debt right now because if your payout ratio is well over 100%, it probably didn't start now, so you're probably over levered as well. You can't take on that much more debt. There could be some interesting opportunities to offer rescue financing to certain REITs, or even if REITs need to shed off some assets, that could be very interesting as well. So I think structures, which could be good in good times, maybe a little bit more challenged in tough times, could bring some opportunity for everyone on this panel. Yeah, those are just my thoughts on the fee structures and the different structures offering opportunities post-pandemic.
Well, thank you for those thoughts. And in this pandemic, like every other downturn, cash is king, and certainly helps the resiliency of transactions going forward. We are almost out of time. Perhaps I can turn it to the extent any attendees have any questions. Maybe we can take a question or two. Or Mike, I think at this point, since we only have about 2 minutes, we can wrap it up.
Okay. Let's see here. So using the Q&A function on the Zoom toolbar, you can direct any questions that you'd like to direct to the panelists or the moderator. With that said, we do not have any open questions coming in. I want to thank everybody on the panel today, all of our panelists and our sponsors. This was a great panel, very, very well done, very difficult issues, and I appreciate your outlook and the crystal ball in the future. I'm sure a lot of the audience did as well. But with that said, thank you guys. I'm going to to move on. We're 2 minutes early, and there's some things that I'd like to personally catch up on. There's a question that did come in for Lane. What is the tax benefit year one for a real estate professional?
So the real estate professionals are the most benefited by investment in an opportunity zone fund because the depreciation operating losses are all considered active and can be carried back for 5 years. So for a real estate professional in a fund that receives depreciation, this is really advantageous. I want to point out that not every fund is able to pass through depreciation because they haven't been able to solve the sponsor equity and the limited partner equity gap that messes up the capital accounts while distributing depreciation. But our fund has solved that problem. We're the leader in that space, and we're able to pass through in our first year enough benefit that, combined with the deferral of the tax and with the depreciation, some people are seeing better than 60 or 70% tax benefit without the 1231 gains. And if they have the 1231 gain investment, they can be over 100% tax benefit in the first year of investment. So a real estate professional is the best possible scenario for carrying back those losses too. Thanks.
All right. Thank you, Lane. Thank you to the whole panel. Guys, thank you very much for taking your time and sharing on this portion. You know, there was a lot of demand for it. All right. So with that said, I'm going to move on. I want to thank, you know, all of our members of FLIA for making all of this possible. The organization has been growing, and it's through your support that we're able to produce such a high quality event. For this particular event, we have a nationwide Preqin, Boomerang Capital, S&P Global Markets Intelligence, Safe Harbor Equity, the Mortgage Office, Harvest Fertility Management, Millennium Trust, Apex One Investment Partners, Entrust Global, Off the Chain Capital, and Clarion Asset Management, who have sponsored this event. So thank you all for helping make this possible again. So I got to also thank our team here at FLIA for doing a great job, working very long hours to produce this event. There's been, you know, no expense spared, and they've been working tirelessly to make sure everybody's well prepared. And 6 hours per day, 12 hours of content, over 300,000 minutes of live watch time is nothing short of a miracle. And trying to organize and prepare people on the technology aspect is not an easy feat. So thank you to the FLIA team for all of the hard work and preparation. So this is a 5-part series. This conversation has started in the middle of March to bring to you thought leadership in the hardest hit area of the global economy. Also the most promising and fastest growing spot inside of alternative investments for sure. So we are going to do a 2-day event, part 5 in July, and it's going to be held on July 15th and 16th. So if you like this conversation, you're going to love where it's heading in July. We ask that you register through the link that they send you through the chat function. And also, if you want to find it, you can also find it on the FLIA website. We have a digital marketplace that we've been working on. It has a special situations section. We're going to be doing a presentation tomorrow. I encourage you to join that presentation. And if doesn't matter if you're a buyer of investments or somebody looking to list deals, all are welcome. And we're going to roll out our process, our structure to bring the special situations portion of our marketplace to the world. And let's go through here really quickly. We have some upcoming digital webcasts. These are educational in nature. They're on a wide variety of topics, and they're brought to you by Flyer members. You can go onto the marketplace, marketplace.flyer.org, and look at various opportunities that are there. Here's a little screenshot from the marketplace.